Welcome to the latest episode of Damien's Market Update. In fact, this is the last update of 2024. And before we get into a recap of what's happened in markets and what to look out for as we go into the new year, don't forget, if you enjoyed the show, do hit that like button, but also subscribe to our YouTube channel, but also subscribe to this as a podcast on Spotify or any app that you use to listen to your podcast. Now, November's investment markets were a bit of a roller coaster, and that's because they were heavily influenced by three key events. So the first one was Donald Trump's unexpected return to the White House, the Federal Reserve Chair Jerome Powell's rather hawkish stance, and a glimmer of hope in the Middle East. First up was Trump's victory in the US election, which did actually defy a lot of polls that were carried out in the lead up to the election. But his victory sparked the Trump trade 2.0, and the uncertainty that we had in the lead up to the election made any preemptive portfolio positioning quite difficult for most investors. So once Trump's win was announced, the market reacted dramatically as investors rushed to adjust their positions in line with a new political landscape. So global markets reacted swiftly to the victory, with US stocks surging as investors piled into sectors anticipated to benefit from his policies. Most notably, Tesla's share price saw a dramatic 38% increase during the month of November, and that was fueled by CEO Elon Musk's close relationship with the president-elect. The US dollar initially strengthened on the prospects of increased fiscal spending and potential tax cuts, negatively impacting commodities and emerging markets. But concerns surrounding Trump's proposed tariffs on major trading partners like Mexico, Canada, Europe, and obviously China did introduce some market volatility. But interestingly, if you look back at Trump's first term in office, Chinese equities did actually perform rather well and were the second best performing unit trust sector across that 4-year window. So could Chinese equities actually perform quite well during his second term? That's something we're going to have to wait and see. But while US stock markets initially rallied after the election, when the US Federal Reserve Chair Jerome Powell made comments about persistent inflation and the lack of need for immediate rate cuts, it did actually temper some of the enthusiasm that we saw in stock markets. And they also negatively impacted investors' bond holdings. Meanwhile, in the UK, the autumn budget's emphasis on fiscal responsibility and tax increases, particularly for businesses, led to a sell-off in UK equities, especially in the FTSE 250, which dropped over 2% before recovering somewhat in late November. Now, the market's expectation of a higher for longer interest rate environment in the UK further dampened investor sentiment, but the FTSE 100 did benefit from the stronger US dollar versus the pound, and these events highlight that central bank policy can have a greater impact on markets than political developments. As November drew to a close, a glimmer of hope emerged in the form of a ceasefire agreement in the Middle East, and this development, coupled with positive US economic data, fostered a sense of optimism as we entered December. Now, if you take that all in the round and you look at the Trump trade in particular, its impact on markets was significant during November. So the S&P 500 was up just over 5%, the Dow Jones Industrial Average and the Nasdaq 100 were up similar amounts. At the opposite end of the scale, we saw emerging markets which were down around about 2% in local currency terms. But now that the US election is behind us, December's focus will likely shift back to central bank policy. The European Central Bank, the US Federal Reserve and the Bank of England have interest rate decisions scheduled for the 12th, 18th and 19th of December respectively. Of course, investors will closely be watching economic data from major economies for signs of persistent inflation and economic growth or uncertainty, as that could dictate what central banks do going forward. Additionally, Trump's actions and tweets will likely add another layer of complexity to the market, as well as the developments in Syria in recent days. But now investors will start to think about a potential Santa rally in stock markets. So based on my own past research for 80/20 investor members, the Santa rally phenomenon, well, the odds of a positive December, that's what I've taken it to mean, the full month being positive for a particular stock market, the odds of it happening are pretty good this year. Now, last Christmas's performance bumped up the long-term frequency or odds of a Santa rally on the S&P 500 to 73%, while the average December return was bumped up to around about 1%. So that bodes well. In the UK, the FTSE 100 has historically shown an even stronger Santa rally trend with an average frequency of 83% since 1994 and an average return of 1.81% in any given December after you factor in last year's stunning rally. But what makes 2024 even more interesting is that US election years tend to be particularly favourable for Santa rallies. And like I said, Santa rallies, in my definition, is a positive stock market return during the whole month of December. Now, both the S&P 500 and the FTSE 100 have traditionally shown strong positive returns in December following US elections. On 11 out of 13 occasions, so that's 85% of the time, when there was a US election in a given year, we've seen a Santa rally in the S&P 500. More impressively, since the FTSE 100 was launched in 1984, we have seen a Santa rally in every US election year since. That means that 2024 could be a particularly exciting year for the Santa rally phenomenon. So as we head into 2025, stock markets are in a positive place right now. We are seeing all-time highs, for example, on the S&P 500 almost on a daily basis. And with the Trump trade 2.0 unfolding, it traditionally, if you look at history, certainly going back to Trump's presidency in 2016, it's shown it tends to continue right through to inauguration day in January. But after that, it depends what Trump actually does as to what might happen with stock markets. But that's something for the new year to discuss. So if you found this useful, do make sure you hit that like button on YouTube and subscribe to the channel. Leave any comments or questions and I will answer them. And if you're listening to this as a podcast, please do make sure that you leave a review on your app of choice.